important thing here, if I'm an investor, let's go back to the investor, is the most important thing is that you can have is a good strategic asset allocation mix. In other words, you're not going to win by sort of trying to get what the next tip is, and what's going to be good and what's going to be bad. You're definitely going to lose. So what the most investor needs to do is to have a balanced, structured portfolio, a portfolio that does well in different environments. So much of the driver of any asset class returns is based on how events actually transpire relative to expectations. So there's a certain discounted growth rate in equities. There's a certain discounted growth rate. There's a certain assets. You can look at what's priced in. And then what happens is you need to have environments, a quarter of your portfolio in assets that do well when growth is faster than expected, or a quarter when it does well and when it's slower than expected, a quarter when inflation's higher than expected, and a quarter when inflation's lower than expected. So you need to create a good structured portfolio. Then you can make your bets. But this is a whole conversation on how to invest.
No, but here's a question just about bets. You're making the argument and explaining the need to have a diversified portfolio. But most people have a diversified portfolio follow the market, meaning whatever the S&P 500 is, ultimately you're going to be up or down somewhere around there. You and some of your peers consistently outperform the market. And you do that, I assume, by making bets.
Well, we break it into two parts. We have two basic portfolios. There is the strategic asset allocation mix, which we call all-weather, and that just has nothing to do with bets. It has to do with how to make all the assets the same risk parity. I would call risk parity. The problem is when people try to diversify and they own some equities, and equities has a volatility that's large, or they own assets that do well when the economy does well and do badly when the economy does badly, they have a concentration of their risk in some assets. They need to change the portfolio. They need to buy longer duration bonds or leverage the bonds or bring up so that bonds and commodities and pieces have comparable impacts so that whatever happens in the economy will then have a balancing effect. Because the one thing you could be most confident is that asset classes on average will outperform cash. So if you have, that's a strategic asset allocation. That's what the all-weather piece is. Then there's the bets. The bets are zero sum, right? In order for you to beat me in the game, you're going to it's like poker. It's a zero sum game. We have 1,500 people who work at Bridgewater. We spend hundreds of millions of dollars on research and so on. We've been doing this for 37 years, and we don't know that we're going to win. In other words, we have to have diversified bets. We have a lot of diversified bets and so on. So it's very important for most people to know when not to make a bet. Because if you're going to come to the poker table, you're going to have to beat me. And you're going to have to beat those who take money. So the nature of investing is that a very small percentage of the people take money, essentially, in that poker game away from other people who don't know when prices go up, whether that means it's a good investment or if it's a more expensive investment.
We're going to slip in a quick break. I'm going to send it back to Joe, and then we'll come back and continue the conversation. Jeff, and he's got a question for you. Scott?
Hi, Ray. How are you? You've done a spectacular job at being able to call macro trends very well and sometimes very aggressively. One of the things that we've noted over the last particularly few months is the use of judicious amounts of leverage on bond portfolios to try to emulate equity-like returns. I think risk parity is what they call it, and you've done a great job with that sort of thing. Is that a mechanic, or is that an indication of direction of attractiveness, the relative attractiveness of fixed income to the equity market?
A mechanical thing. The problem of, let's say, a stock and a bond portfolio, if you put 50% of your money in stocks and 50% of your money in bonds, the problem is you have about 80% of your risk in stocks and about 20% of your risks in bonds. And so you don't have diversification. But if you just imagine that you had a long duration bond portfolio or a bond portfolio that had about the same volatility as stocks, and you went through the financial crisis, most of the decline in your portfolio would have been protected because the stocks would have gone up in value by an amount that would have had an impact that would have offset the other. So in structuring a very good portfolio, you have to have basically comparable amounts of risk in that.